So I've been trading for about 8 years, and I've been profitable for about 6 of these past few years. And what I've learned is that the stuff that I see a lot of people doing just simply doesn't work. The stuff that I see a lot of people saying simply doesn't work. A lot of the stuff that I see people giving you advice on what you should do doesn't work. So I'm in the minority here in the fact that I say everything in this video is just my opinion only. I do in fact make money trading even when I'm wrong. I don't have any predictive edge. There is no type of speculatory power that my trading approach provides. There's also no black and white rules. It can seem complicated to people who do not have the experience to dictate and justify that what I'm doing is working, because everybody trades in their own way. Nothing in this video is financial advice. You're probably going to continue losing money trading. Trading's risky, and most people do in fact lose money trading, so you probably shouldn't even do it to begin with. But if you're crazy enough to continue trying to do trading, I will show you what's worked for me. First, let's look at not even a chart. We're going to look at up and down lines. Now, pretend that this is a market and you want to buy. So you're going to buy, and whenever you buy, you have to decide where you're going to put a stop loss, a take profit, position sizing, how much you're going to risk. Are you calculating it based on a lot size or based on how much you're going to risk? You have to do all this stuff. If you strip away everything and you keep it simple, and you just say, I'm just going to buy with, let's say, a 1 standard lot size, there's a 50% chance of price moving up and a 50% chance of price moving down. So if you structure this into a trade, you could say you could buy there at 1 standard lot, and if price goes up, we're just going to pretend you're going to make $100, and if price goes down, you're going to lose $100. So with a 1-to-1 risk-reward ratio, entering randomly on the chart anywhere, you will have about a 50% win rate, and you'll have a break-even system. Now, the nature of price dictates that price does not typically go one direction forever. Price goes up and down, and then sometimes you'll have quick, aggressive, sustained moves up with no pullbacks, but eventually markets typically pull back. Now, there are times where the market can run up for a very long period of time without pulling back, but in general, most of the time, most markets are mean reverting, meaning they extend one way, then they pull back to their average price. Then they extend another direction, then they pull back. They extend one way and they pull back, and they just go back and forth, up and down, over and over and over. So trading is a very interesting form of betting / gambling in the sense that the further price moves in one direction, from my experience, the more likely it is to eventually have a pullback. Now, the crazy part about the approach that I use is that you don't have to have any type of edge. You don't have to have a reason for even entering the trade. You don't have to have any type of specific reasoning. You don't have to have any trading rules or anything. With this system, you could literally enter randomly on the chart, and provided that your first position is sized small enough, it allows me to profit regardless of what happens. Now, I win outcomes a large percentage of the time. Some weeks it's 90%, some weeks it's 99%. However, every now and then I take a big loss, and that loss blows whatever trading account I am trading. Now, the way I get around this is I fund an account that has a small percentage of my trading capital in it. So for all the trading capital that I've allocated specifically to trade FX with, let's say it's 1.2 million. I allocate, if I put a 50K account and I start that account with a $50,000 starting deposit, if I blow that account, that's less than a 5% risk of my capital allocated to just trade specifically FX. So what this means is that the account is essentially my stop loss. And if I know that a large percentage of the time I can get the account to a certain growth target, in my case, it's just doubling the account, growing it from 50K to 100K, or 100K to 200K, or 150K to 300K. If I can double it most of the time and then internal transfer the profits out and start again, I know I can trade that one account really high risk with the intent to grow it and capitalize on the fact that markets do essentially pull back over and over and over and over. I used to always say keep things simple and control risk, but now none of that even really applies. All that really applies is just control risk. Because keeping things simple or making them complicated, to begin with, that's all subjective in the first place. What's simple to me might not be simple to you. And what's complicated to me might be very simple to you. So that's all subjective to begin with. One thing that cannot be looked away from, though, is the concept of controlling risk. You have to structure risk in some way. If I took all the capital I've allocated to trade Forex with and risked it on one trade with a 1-to-1 risk reward ratio, I would either double my trading capital or lose all of my trading capital. Is that a good way of structuring risk? I don't think so. However, taking a percentage of my trading capital and putting it into a small account and then using that capital to grow that account quickly and aggressively, that works for me. And this specific approach has worked for me for the past 2 years. I made more money trading the year that I traded just this approach than any other trading approach where I've tried to get an edge to predict where the market's going to go. Essentially, the past 6 years I've only been profitable because I've been good at controlling risk, and that's it. I cannot predict where the market's going to go more than half the time. And oftentimes, I think even less than a 50% chance I'm going to be right the first entry. Now, fortunately, with this approach, it doesn't matter when I'm right, as long as I do happen to be right and I've controlled risk and sized the position appropriately. It allows me to make money even when I'm wrong. I'll give you a quick example here. Let's say price is in an uptrend and it goes up and it makes a higher high and I sell. Let's say the account is $50,000 and I use a 1 standard lot size. That means the market would have to go very far against me for me to actually blow the account. But if I know that the market typically pulls back and goes down at some point, then if it bounces immediately and goes down, I can close the trade and profit there, make, let's say, like $500. If it goes against me into a $500 drawdown, I can add again wherever I believe price is likely to reverse. So typically I'll just let it run against me. I'll watch the candlesticks and the price action to see when I think it's likely to start pulling back and for the momentum to kind of slow. Then I'll add a second position, generally the same lot size. Now, if it pulls back, I'm break even on my first position and I'm profitable on my second position, and I can generally close both positions right there at that area. Now, if the market stretches further against me, generally I'll just let it run until the next area I think it will bounce. You can use anything you want. You don't even have to look at support or resistance, but sometimes, like, let's say there's like a major support resistance zone there. You could say, okay, well, I think it's going to bounce there, so it's at a support resistance zone, so I'll sell. But you don't even have to do that. You can just literally add a position anytime that you think it's likely to revert and start retracing. Generally, after big spikes upwards, you generally see some sort of retrace. And you don't even have to get a complete reversal to make money. You just have to get some sort of a retrace, and you can get out of most trades at either break even or profitable. So that said, if the market pulls back from here to here, then I can close this position at a profit, and then I break even on this position. And since they're all the same position size, I can just close that position at a loss. The profit and the loss offset each other to break even, and the middle position was closed and break even. So even though it's completely wrong, I could still at least break even on this. And in some cases, the market will continue to have a big bounce, and then you can just keep holding it depending on whether or not you think it's going to keep going. This all comes with experience. There's no way to teach this. It all just comes with black and white experience. Not black and white experience. There's nothing black and white. It all comes with experience. And with that being said, all I can do is kind of help guide you as to like the best way to accumulate that experience. And it's essentially just comes from testing and experimenting and optimizing and observing and seeing what works and what doesn't. So in the cases where price goes up and it just never pulls back, you can do this on any time frame. You've added, and you've added, and you've kept adding. And I'm trying to select this here. Let's just say you add like 20 times, right? Eventually you will hit a market where it just runs away and it blows the account. But most of the time, the market will retrace, and that will allow myself to get out of a trade at usually either a break even or a profitable scenario. Sometimes I'll take a loss. It's like maybe 5-10% of the time. But again, the percentages can vary for weeks, so don't take the percentages as a black and white number. Just understand that the point that I'm trying to illustrate here is that most of the time, the market will not do this. The market will have some sort of a retracement at some point and pull back. So what I'm going to do is we're going to go to like a random back test scenario. And I'm going to show you just doing this like on a chart in a back test scenario. Back testing has its limitations. Past performance cannot predict future results. It is what it is. We're going to simulate that we have a 50K account. And we're going to use 1 standard lot size, and we're going to take maybe like 5 outcomes of trades, and I'll show you. So we're going to say, let me just click seller to see what the sizing is to see how much. NZD, okay, yeah, so that's a little bit heavy sizing. We're going to use 50. So we'll be using half of a standard lot, 0.5 lots. So here's what we'll do. For our first entries, we won't even do any analysis. We won't look at trend. We won't look at support resistance. We won't look at market structure. We won't look at fair value, distribution, Wagyu beef, candlestick, ICT, smart money concept, liquidity, order, bank manipulation, strategies to try to figure out where the market's going to go. We're not even going to really give a shit where the market goes. We're just going to buy or sell. So I'm going to just use a random number generator. And if it's 1, we'll buy. And if it's 2, we will sell. Fair enough? It's 2, so we're going to sell. Now, if the market goes against us, let's say up here, we'll be in a $2,000 drawdown. But we could then sell again because when the market makes a higher high, it's likely to retrace at some point. Also, if the market goes up here to this previous high, that'll be in a $600 drawdown. We could also add right there. So what I'm going to do is I'm going to add if price goes up to that zone, and I'm going to add if it makes a higher high. So unfortunately, we didn't get to add in drawdown. Unfortunately, it was a winning trade. So we can close it there. Now we're at a support zone, so that might tell some people to buy. But foolishly, we're still going to do a random number, and this happens to be 1, so we will in fact buy. But even if it was wrong, we would still have entered whatever the random number said. So unfortunately, we have another winning trade, and this will happen roughly 50% of the time. Roughly 50% of the time, the market will move into a profit, and 50% of the time it will move into loss. So every now and then you'll just get random win streaks, and understand like we're literally entering randomly with just a small position size relative to a 50K account. A 0.5 lot with a 50K account is almost nothing from my experience. So far we've made a $1,400, or this is NZD, New Zealand dollars. So now let's pick another random number. So 2. So that means we'll sell, and hopefully it goes into drawdown so I can illustrate this. So it does in fact go into drawdown. So we're here at the next resistance zone. So let's just say we add there. Again, you don't have to add at a resistance zone. You don't have to add at a trend line. You don't have to add anywhere specific. It can just literally be the next spot where you think, price might reverse here, so I'm going to add another position here. Remember, you're not trying to profit from predicting the direction. You're just trying to capture the volatility. You're trying to allow yourself to size accordingly. So that way, when the market does eventually reverse, for 1, you don't blow the account. And for 2, you end up coming out at a profit or break even most of the time. So it went into profit. I didn't take profit. I think it might go higher, and if it does go higher, we'll add again. And if it goes into profit, maybe around the previous lows, we'll just take profit. So fortunately, this went up higher. And remember, we've got 50K in the account to play with. So it's currently at about a $2,000 drawdown. We're going to add another sell up there. So now we're in 3 short positions. We've added twice, additionally to our first entry. On this, I'll take profit if it goes to the previous lows. So I think it'll bounce here at the support zone. But again, I'm only right half the time, and you're probably only going to be right half the time. And nobody knows where the market will or won't bounce. But the question is it a good idea to probably take profits now based on the risk structure? Yeah, we're in 3 positions. It's gone into profit. It was a good trade. That was our third outcome. Now, let's just flip a coin again, and it's 1, so we will buy. So I hope it goes into drawdown. If it goes to these previous lows down here, then I'll buy again. And if it goes around this previous high a little bit before it, I'll probably take profit. So unfortunately, It was another winning trade. I'm sorry. We'll take profit there. We've made a 5K NZD. So now we'll do another random number. So 2. So we'll sell. Again, we're just randomly entering buy or sell positions literally by flipping a coin. There is zero technical analysis. There's zero analysis at all. There's no sort of fundamental analysis, like there's nothing. It is just literally entering buy and sell positions randomly with the position size that is small risk relative to the account balance. Okay, just want to throw that out there. We're not speculating at all. So I'm going to close here just because it's had a nice move of profit. This has been 5 outcomes, but 4 of the outcomes resulted in an immediate profit. Only one of the outcomes did we have to essentially do like recovery trades where we're just adding in drawdown and adding at the next zones. So what I'm going to do is, since we had random, again, we're literally entering randomly, this had an 80% win rate from the first entries. So what we're going to do now is we're just going to do like 1 or 2 more outcomes. I want to get an outcome that really goes into drawdown so that I can demonstrate this to a better degree. So we're going to buy. And again, this is with just doing a small 0.5 lot size, buying and selling randomly, and then just adding if it's wrong, and then waiting for it to pull back, then taking profits, or closing it in profit if the first position's right. So a 1, that means we're going to buy, so we'll buy. Hopefully it goes into drawdown. So it does go into drawdown, so we're going to buy again here at this support, thinking, maybe it'll bounce here. And if not, we'll buy again at this support down here. So I'm sorry. This went into profit again. My apologies. Now we've made 9,000. I'm going to do it 1 or 2 more times. Hopefully we get something that really goes into a lot of drawdown. Here, this is perfect. I'm going to buy at a resistance. That was the 1. So this goes into drawdown. So now what we're going to do is we're going to buy again. Some people would say, wait for the support. But just to stress test this and show you how it literally just doesn't matter, we're just going to buy again here, and this is just completely random. If it goes further down, we will buy at the support. So we bought at the support. Now we're going to see if this can go into profit. So it goes around to the previous highs and we close. Now we made 11,000 NZD. This sort of highlighted it a little bit more. We literally bought at resistance, completely wrong, bought again, completely wrong, bought a 3rd time, and then we were right. So trading this way allows you to make money even if you're wrong a couple times. You can be wrong first, but as long as you're right at some point and you're sizing appropriately, it's really difficult to blow the account unless you're sizing heavily. Now, do I size the same way? No, I size extremely more heavily because I know that 75% of outcomes are likely to be closed at a profit or break even after 3 trades. Every now and then I'll go into a 4, 5, 6 trade drawdown, and then I'll be in drawdown of like 40 to 50% of the account. Just last week, I was in an account that had $80,000 that was in a $40,000 equity because I was in 50% drawdown. But I know the stats and the metrics, and that eventually things generally do revert, so it allows me to get to my growth target of doubling the account much more quickly. Sometimes as quickly as 4 to 6 weeks. Not all the time. There's been times this has taken me like 3 months to do. There's been other times it has taken me only 3 weeks to do. So it's important to just know that everybody's metrics are going to be the same. This is just to give you sort of a proof of concept in a way that you can go about testing this to learn all the nuances through experience. We'll do one more. So that was a 2, so we will sell. We'll add in profit. I will add if it goes to the highs. Perfect. So we'll add another position. Then if it makes a higher high, we will add again. Let's be really risky. Let's add a 3rd time around the same price. So we made a higher high. Gonna add a fourth time. We're in a $3,000 drawdown. Add it again. So we've went into drawdown again. So we're gonna add a fifth time. We're still making a higher high. I'm gonna add a sixth time right here. We're in a $7,000 drawdown. So I'm glad this happened. Now I can show you how it stress tests. Add an eighth time, and we pretty much wiped out all of our profits in an open drawdown. We're betting on the likelihood that price will eventually revert. We're going to add an eighth time up here. It does take a lot of patience at times. In my opinion, it would not be a great time to add because it's already so low it could reverse back up and we'd be in too heavy. At this point, I'm just going to attempt to get out of this at break even. Okay, you get the point. So I'm going to close there. It's around break even. It was a little bit of a loss in this case. But essentially, by just continuing to add, we wiped out the open profit. We didn't really dip too much below the original starting balance in this case. But again, this is a case where there was 8 trades in total, I believe. 7 or 8 or 9. This is a lot of trades. This is a lot of being wrong over and over, but that's why it's important to size your original position accordingly. Another thing to point out is look at how often this happens. Of all the trades we took, you can rewind this video, you can count here. How many of them got into more than 3 total trades? Very few of them. But even when that happens, the account would have been over 60K. That would have been a 10K drawdown. So the account still would have had 50K in equity in it. So that's like less than like a 20% drawdown. And that's like, that happened once out of, it was almost 10 outcomes, I believe. It was like 7, 8 outcomes, 9 outcomes maybe. That doesn't happen very often, but even when it does, we still wiggled out of that at break even. A note, if you're going to go and test this, make sure that whenever you're doing this, you do this on a demo account first. You're probably going to lose money trading live. Whenever you test this on demo, use a reasonable starting balance on the demo account that you would actually be trading with if you were to trade it live. Sometimes you only have $1,000 to trade with. That's okay. You're probably not going to become rich trading just $1,000, but it's a great place to start because most people are getting into trading because of the reason that they want to make extra money and they don't have a lot of money. I completely understand. You're just probably not going to make much with $1,000. Full disclaimer, just keeping it real. However, start a demo account with $1,000 if that's how much you have to trade, or 10K or 50K, whatever it happens to be. And use a very small position size. Literally, like if you start a 1K account, then just put like a 0.01 lot size. You can literally start by just entering randomly. Half the time price will start moving into profit, and you can close it wherever you feel you should close it. There doesn't have to be any rules. And whenever you're wrong, figure out how to manage it. Where should you add at if you're wrong? Where would be a good place to add at? As long as your position size is set appropriately, it allows you to capture the volatility regardless of where the market moves, and it's very laid back and chill. If you can look during this whole back test, we took a 50K account and a simulated market environment from 50K to 60K. And this is with me sizing like abysmally small. We could have grown that account much, much quicker and probably even doubled it had I used my normal position sizing, which is generally about, it's different for every trade, but 2 to 3% is what I'll risk from the initial trade to the point at where I would add the second trade. This allows me to most of the time not get more than 10% drawdown on an outcome. And if I'm right, I instantly make 3%. And since I'm right most of the time, it's 75% of trades I'm able to close in profit or break even after only 3 trades. I have like 90 to 95% of the time the trade will end in a profitable or break even outcome. And then I'll have to manage the really bad losers like 5-10% of the time. Sometimes it doesn't even happen on an account. Sometimes it just goes straight to the profit target for most trades, and I barely have any losses and I just grow it. Then I withdraw the account. The fact that I withdraw / internal transfer the profits from the account to another account and then restart with the original starting balance, it allows me to double accounts over and over and over. And most of the time I know I'll be able to do that. But whenever I blow the account, it's just a small percentage of the profits that I made relatively, right? If I can take 5 accounts and I can grow like, let's say like 4 out of the 5 accounts to the growth target, right? So say I start like a 50K account and then I grow it to 100K. So out of those 4 accounts, I'll make $200,000 profit minus the one blown account, it's minus 50K. That leaves me with $150,000 profit. And again, this is without trading with a single edge. This is just using proper risk management. It's not predicting the market. There's no speculation. There's nothing. If you approach trading this way, I think it's a much more peaceful way to trade. I've traded so many different methods over the past couple years. A lot of them the past 4 years have been based around just support resistance and trying to figure out like dynamic position sizing and how to get in, adjusting stop losses, using hedging, using DCA, adding all sorts of different things. What I found is what seems to work the best and what seems to work the easiest is just profiting from the market moving wherever it's going to go and simply controlling the risk in such a way where you know what the stats are. So then you can bet on the stats and you let the stats play out without having to worry too much about getting things right, because then that leads to a lot of emotions. It leads to a lot of fear. It sometimes leads to like revenge trading because you were wrong and you're upset that you were wrong. So you then risk more to try to recoup the losses from when you were wrong, which typically results in a blown account anyway. If you approach it this way, I just think, in my opinion, that it's a much more peaceful way to do things. You do not have to be right to make money. You can literally be wrong, like we saw in the last example on the chart. You could be wrong 7 to 8 to 9 to 10 times in a row and still come out break even. There's not many systems that offer that. And even if you're using a system that uses stop losses where you're trying to predict where the market's going to go, you will still, my friend, take 5 to 10 trade losing streaks at some point in your trading career. And if that risk percentage is too high, it's going to wipe out a lot of the profits you made, or it's going to blow the account anyway. And you're trying to predict where the market's going to go, and you think you might be doing things wrong, and you think like you could be doing it better. So you try to figure out how to get a higher win rate. It's all of this stuff, and it's all this nonsense, and it's useless in my opinion, because I don't really see many profitable traders that have more than around a 50% win rate. I myself have a 50% win rate or less most weeks, but I still make money. Why do I make money? Because I don't have to predict where the market's going to be right. It is because I can make money even when I'm wrong. And the purpose of this video was to illustrate that exact point. Hope it was useful. See ya.